All right. Okay. Very good morning, guys. Can you all hear me and see your screen? Yes. Can you see screen? Fine. Right. Okay. Perfect. So I'll give you a couple of minutes. If you have any friend on the group who is missing in action, maybe you all can give them a call, wake them up, and remind them that there is class. Once again, guys, on your end, try your level best to come to class, right? Because I can't guarantee on the recording. I can't what guarantee when the recording will come up. The main issue is all the recordings, all the videos were made, and the laptop that we made the video broke down, right? So we need to rework all the recording. That is why now YouTube channel there is only, I think, until unit 3. Okay, hold on, give me a second. Yeah, so not very sure as to exactly when the recordings can come, and don't wait until the very end to keep watching recordings, and don't have that as a practice as well. So on your end, try your level best to be there in class, try and learn it then and there, and then finish things off, right? That has to be your main goal. At the end of the day, it's done for free. So do come, do learn, finish things off. Okay, right. I'm not going to waste a lot of time. We'll start from where we stopped. Okay, I think okay, few things to address. I think we have a few new faces. I don't know if they've actually shown up, but I saw a few people have joined the group, and a lot of people asked me for the group invite as well. So for the people who've joined newly, just to let you all know, what we do over here is we discuss A-level, English medium, econ, past papers. And how do we do it? We don't do paper by paper. We go unit by unit, right? So far we have completely discussed unit 1, 2, 3, 4, 5, and 6. We started unit number 7 last week, that is on Saturday. We started off with the MCQs. So we started off with the MCQs of unit 7 in the 2011 paper, right? We discussed the 2011 MCQs, right? We've gone through all of that. Then we went through the 2012 ones. Okay, so all the ones relating to unit number 7. So 2012 was done, 2013 was done, 2014 was done again. I think this recording was there. I uploaded on the group because some students couldn't make it, given that my Zoom account could only have 100 participants. 2015 was done and 16 was done. Y'all can get the recording. It was sent on the group, I think yesterday. I was waiting until the very last moment because I know new people would join in and they also would start asking. That's why I sent it at the end. So this is where we need to start today. We need to start with the 2017 A-level paper. Okay. So on your end, what I would expect y'all is I would expect y'all to do the questions and come, because I will not be giving you all time to do the questions, because at the end of it, that's a waste of time again. So on your end, you usually have some idea as to how much we do per day, right? So first we finish off the MCQs, then we go on to the essay questions. I'm not going to tell you do this question, and come. By now, I'm pretty sure that you all know what are the unit 7 questions, right? Which question is from which unit by now, with 2 months to go. Is it 2 months? No, I think around 3 months. Exactly 3 months. I think today is the 14th. You have the exam on the 15th of November. If that's the date, right? When is the exam starting? Econ paper 1, 15th November. Yes. So is it some other day? They said 15th November, right? Okay. I'm not very sure if it will happen in the 15th, on the 15th of November, the way it's going, but let's hope and pray that it happens on the 15th and it's done and dusted. But that means that's exactly 3 months to go. So you have September, October, yeah, and November. So exactly 3 months to go. And at that level, I expect you to have some sort of knowledge on the unit as well, right? So again, I'm repeating, guys, for people who came in newly, I don't go into very basics. I don't go into teaching every single thing in this unit. This is not a theory class. This is not a revision class. This is where I simply discuss the past papers. So if you're trying to learn the unit for the very first time through this class, then this is not the class, right? So here what we do is, I'm hoping that you all have learned the unit. I'm hoping that you all have done the questions. We simply discuss the question, right? Okay. We'll start off with the 2017 A-level paper. Okay, that's question number 30. Please, have you all done the question? Yes. Did it 17, 18? Okay, the plan for today is, I'm not very sure how long the class will go until, but the plan for today is to finish off the MCQs. That's all. I'm not going to start the essay questions because I don't think I can do much, right? So the plan for today is to finish off the MCQs. Ideally, we'll try to see if we can finish off it in 2 hours. If it doesn't finish off in 2 hours, we'll at least take a bit longer and we'll finish off. If it finishes before 2 hours, then yes, things will finish off early. Okay, but ideally somewhere around 2 hours. Okay, we'll start off with this. This was, okay, 2017, a paper that I can personally relate to, the paper that I actually did. Okay, question number 30. We were supposed to have a longer class, but I'm a little bit caught up with my exam starting on Monday. So I have my end semester exam starting on Monday, which is going on for 2 weeks. It's a little bit messed up and a little bit too stressed out. Even right now, I woke up early in the morning to study, but still, given that I still promised you all that I would do the class, I am doing it. We'll see. We'll try to finish off the MCQs. I think that's a good part to do. Okay. Right. Question 30. What will be the probable effects of an increase in value-added tax on demand pull inflation and cost push inflation? A bit of a tricky question. I remember me also sitting in the exam hall wondering what exactly this effect could be. What do you all think? What do you all think happens here? Okay. Now, this can be argued in different angles, right? So according to, I think, how the examiner would have argued, okay, I'll just give you a small explanation what happens here. So when VAT, now you all know VAT is value added tax that gets added on the goods and service. Now we study this in unit number 3, right? Taxes on goods and services. So when there is a VAT imposed, just give me the things here. What happens to, right, the cost of production, right? So if the VAT cannot be, let's say, passed on entirely to the customer, let's say the producer is bearing half of it, customer is bearing half of it, what happens to the cost of production? Cost of production increases. So when the cost of production increases, what happens to supply? Supply, your aggregate supply or whatever your supply decreases. So when your supply decreases, that's a leftward shift of your supply curve. What happens to prices? Or in other words, if you talk about your inflation, supply decreasing, a leftward shift, are you sure that the prices fall? Supply decreasing is prices increase, right? When supply decreases. Okay, so on that argument, you can say that when this happens, there would be cost push inflation. So prices will definitely increase. In order to show this, maybe if I am to graph it, right, how it would look like is something like this. Okay, let me see if I can draw this. Okay, so you have your aggregate demand, you have your aggregate supply. Okay, so as a result of a VAT, what happens? The cost of production tends to increase. When the cost of production increases, what happens, guys? The supply, right? The supply falls, guys. A supply fall is a leftward shift. So a leftward shift, what happens to prices, guys? This is the price. Now the price starts to increase. This is a general price level, right? This is the aggregate supply curve. So prices tend to increase. So as a result, you say there is cost push inflation. So cost push inflation, your argument can be that it increases, right? So we can cut off answer number 2, answer number 4, and answer number 5 because it says unaffected and decrease. Okay, I'm hoping that cost push inflation part is okay. So I'm cutting off a few answers off. So then we still don't have a complete answer, right? So demand pull inflation, does it increase or does it decrease? Now on this end, there's a 29th question. I think I would have explained on the previous session when we did unit number 6. Okay. So when there is a VAT, what do you think happens, right? What do you think happens to the price of the good, right? Say the customer needs to pay the part of the VAT now. The price of the good increases, right? So when the price of a good increases, what do you think happens to your demand? Do you buy more now? Law of demand, basic law of demand. When the price of a good increases, you buy less, right? So your demand decreases. In other words, your consumption, right? Consumption, you can say that the consumption decreases. You can argue it that way. Okay. Given that consumption decreases, what happens to aggregate demand? If consumption falls, aggregate demand. Aggregate demand is a combination of C plus I plus G and NX. Consumption falls, aggregate demand falls. If aggregate demand falls, what happens to demand pull inflation? Exactly. So you can argue it this way, right? So now I totally agree that there could be different other arguments also, right? Which you all feel, so why can't this happen this way? Why should it always happen this way? I also totally agree. I also had that exact problem, right? But remember, there are questions like this that come, which sometimes it's based on, you also don't exactly know what the examiner is thinking, but I'm pretty sure in this question, this is what the examiner is thinking of, right? So then we end up with answer number 1, right? Demand pull inflation decreases, cost push inflation increases based on these arguments. This is the explanation why cost push inflation increases. This is the explanation why demand pull inflation decreases. Okay. So 30, we end up with answer number 1. If I'm to show that in a graph, maybe what happens here is your aggregate demand falls. Okay, hard to show that here. Okay. Aggregate demand falls, and as a result, let's say the price which was here now comes to this level, right? So your prices fall. I'm hoping that's fine. Yes. So we'll go on to the next one. Okay. Right. Moving on to the next one. I think that is one of the easiest questions you'll ever get. Which of the following assets is most liquid? When you say liquid, what is the easiest to convert into cash? Savings deposit, treasury bills, demand deposits, treasury bonds, real estate. Very simple question. Even if you have not answered, you can look at your answer now and tell me an answer. What is the most liquid? Liquid in the sense, how easy is it to convert into cash, right? So the most liquid is demand deposits. Okay, from this, if I'm to ask you, okay, the most liquid is demand deposits. After demand deposits, what is the next one? What is the next one that is most liquid? Okay, let's say demand deposits is number 1. That is the most liquid one. Shall we rank this? Okay, this is the first, right? The most liquid is this. Which one is the next one? Second, after demand deposits. It should be the savings deposits, right? You can easily withdraw. After the savings deposits, what do you think is the next most liquid one? The third one. Exactly. The treasury bills. You can give the treasury bills as the third one. After that, which is fourth? The treasury bonds are fourth, and real estate is the end. So in case in this question, they asked you, right? If they ask you, what is the most illiquid, right? Not liquid, the most illiquid, that is the hardest to convert into cash, then your answer should have been real estate. But usually they don't ask that. They usually ask you what is the most liquid. Yeah, so it's a demand deposit. I'm hoping that's fine. The most liquid is demand deposits. They've asked. Okay, so they've asked asset. Yes. Now, that does not mean they have not said asset for a commercial bank. Demand deposit for a commercial bank is a liability. Totally agreed. Now, they have never said which of the following is the most liquid asset for a commercial bank. They have simply said most liquid asset. So it can be anyone. Even now, for example, a demand deposit is an asset for you, right? For a company or for you, it's an asset because you have put your money. So unless they have specifically said it's a most liquid asset for a commercial bank, then you can say demand deposit is not an asset, it's a liability. Totally agree. Got it? They're not highlighting commercial bank here. So you can't say that it's a liability. Okay, that's 31. Okay, then going into 32, again, a very easy question, right? Suppose you deposit 10,000 in your deposit account in a commercial bank. If the bank wishes to hold 20% of all deposits on reserve, so they have a SRR of 20%, how much new deposits can it create as a direct result of your deposit? So a 10,000 comes, the banks can need to keep 20%. So how much of deposits? Now, whatever loans that they give is the deposits that they make, right? How much of new deposits can it create? Yes. The answer is you don't have to go into a multiplier. I don't think you need to go into a multiplier here. Just okay, let me know what the textbook, not the textbook, what the past paper also says. I'll explain you my logic. Let's see if that's what comes. So a 10,000 comes in, right? As a result, right, the bank keeps in 20%. So how much do they need to keep? They need to keep 2,000 with them. And then, so how much of loans can they give, guys? How much of loans can they give? From the 10,000, if they keep of 2,000 with them, they can give 8,000. So how much of deposits can it create as a result of your deposit? Guys, it's 8,000. It can't be a multiplied answer. They're asking, see, they're saying if the bank wishes, right, to hold 20%, how much of deposits it can create? It here means the single commercial bank. They're not talking about a banking system. If they ask you banking system, then you can say 10,000 multiplied by what? 50,000 worth of total deposits is created. But here when they're asking you for a single bank, guys, right? So for a single bank question, you don't use the deposit multiplier. For a banking system question, you use the deposit multiplier. Right? I think I would have made that very clear in whatever thing that we would have learned. So here they're talking, first of all, remember when you get a credit creation question, you always, the first thing you figure out is, are they asking a single bank question or are they asking a what? Is it a banking system question, right? That is the first thing that you all need to figure out. Once you all figure out that, only then you all can go into an answer. So here, if you're looking at it, right? Because monopoly bank, you go as a banking system. I think we discussed that last class. Okay. So there's a 10,000 that's coming in into one commercial bank, right? If the bank wishes to hold 20% of all deposits, so in case they ask how much is the new deposits, right? How much is the new deposits that can be created in the banking system? Then yes, you could have multiplied and given your answer. But here, how much of new deposits it can create? It here refers to what? Refers to the single bank. So how much of deposits? It's that 8,000 which they can give out as loans that goes as deposits. I'm hoping you all remember the two-step process, right? How this works, how the bank gives a new loan. When they give a new loan, they add it into your account. So when they add it into your account, that is a new deposit that is being created. And I'm hoping you all remember credit creation. Okay, I'm not going into basics. So answer is number 1 there. Okay, 32, answer number 1. Right, then going into the next one, question 33. Again, a very easy answer. Easy question, not that hard. Which of the following happens when the central bank reduces its policy interest rate? Guys, when you say policy interest rate, what comes under this? Under policy interest rates? What comes under policy interest rate? Exactly. You have the bank rate, right? So you have the bank rate, the standing deposit facility rate, right? And the standing lending facility rate. So these three come under policy interest rates. So you don't have to know all of these three, what these are also. But in simple terms, if the government reduces this, sorry, not the government, if the central bank reduces this, whatever, now even currently, right? Think of the current situation. Currently, are these policy interest rates high or low? Currently in the Sri Lankan economy. Are these high or are these low? These are low, guys, right? So why do you think the government reduced this or the central bank reduced this? So currently in SL, the policy interest rates, I'm just adding a few additional points, right? Rates are low. Why do you think they would have done this? What happens when you do this? Yeah, exactly. These policy interest rates are low. So as a result, now remember, standing deposit facility rate and the standing lending facility rate, they set the upper limit and the lower limit for the money market interest rate, that is short-term interest rates. So as a result, all normal market interest rates will also fall. Why do they do this? Right? When interest rates fall, what do they ideally want to do is they want people to spend, they want people to borrow, and they want people to spend. So they want consumption and investment to increase. Now, right now, the economy is not doing that great. So what is the government doing? They're trying to reduce interest rate so that people would actually borrow and people would start spending, right? So they want to, what is the goal of reducing this, right? Applicable to the current context, to increase investment and consumption, right? To increase spending. Now, what do you think happens to money supply or money demand here? Yes, money demand, there is no direct effect, right? You can't talk about money demand really here, but money supply you can talk about. Think people are borrowing, people are investing, banks are giving loans. What do you think happens to money supply? Money supply increases, right? People are borrowing, they're spending, right? All of it is happening. So money supply in the country is increasing. When the supply of it increase, what do you think happens to the interest rate? Yes, interest rate is the price of money, right? So when supply of something increases, what happens to price? It decreases, right? When supply increases. Okay, so that is where you get your answer. So what happens? Money supply increases, people are spending, money supply increases. As a result of an increase in money supply, right? What happens? Interest rates fall. So why? Interest rate is the price of money. So if you have a lot of supply, if you have a lot of money in the economy, then the interest rates will fall. So that, okay, which one do we have as an answer? Money supply increases, market interest rate decrease. Okay, the fourth one. Okay, that would be an answer. These are very simple questions, right? If you actually know the unit, this is not at all hard. Trust me, this is not at all hard. If it's hard, I'll let you know that it's hard. Okay, don't lie. No, that is a very simple question. Why can't it be one? Usually this, right? Decrease in interest rate, yes, money demand increases, market is. But here now, when since they are specifically saying policy interest rates, right? So that is why I feel this is a better one, right? Because now your monetary policy, right? Your policy interest rates are mainly there to control the supply of money, right? Control the amount of money that is there in the economy, not to control the demand for money. In case they have just highlighted, okay, in case this question said, right, I totally agree that if interest rate reduces, demand for money will decrease, interest rate will not decrease, then yeah, interest rate decrease. Okay, that's fine. But here they're specifically saying policy interest rates, right? Now policy interest rates are monetary policy tools. Why do you use the monetary policy? Not to control the demand for money, it's ideally to control the supply of money, right? How does the demand for money decrease, guys? If interest rate, sorry, it has to increase, not this, sorry, not one. Okay, the speculative motive, you can argue on speculative, not this, I'm sorry. You can argue the second, no, demand for money, interest rate reduces, demand for money increases, market interest rate increases. Okay, you can argue the second one, right, on the speculative motive, but here again you can't argue really, because guys, I'm hoping you all know what the speculative motive for demand for money, when interest rate reduces, right, that the demand for money increases. So you can argue there, but once again my point there is your policy interest rates monetary policy tool, right? A monetary policy tool is not used to control the demand for money, it's usually used to control the supply of money, the amount of, now why do you use the monetary policy? It's to control the money supply, right? The normal definition, right? If they haven't specifically mentioned, it's a supply side policy. Please, they will not specifically mention you. Please, basics. Give me the definition for monetary policy. Oh, okay. Monetary policy definition. Monetary policy definition. What's the definition? I'm not talking about objectives or anything. What is the monetary policy in simple terms? Exactly. What is the monetary policy? You're talking about controlling money supply, right? Right. So monetary policy right? That it comes from the definition. So monetary policy is a tool, right, used to control, right, to control the money supply. Now, am I saying money demand there? No, to control the money supply and interest rates, right? That is what you're trying to do. So when they tell you policy interest rates, right? Policy interest rates are quantitative measures of monetary policy. What is it there for? It is there to control the money supply, guys. So that is why you don't argue on the money demand part. I'm hoping that is clear. Yes. Policy interest rates are there for what? It's there. It's under the monetary policy. Why is the monetary policy there? To control the money supply, not to control the money demand. Okay, that is why you go with answer number 4. They don't have to directly say that it's a supply side thing. Okay. So that is why we end up with answer number 4, question 33. Then we'll go into the next one. Okay, not a very direct one, but a bit easy. Question 34. The primary goal of the central bank is, for anyone who has joined newly, we are in the 2017 paper, right? Okay, the primary goal of the Central Bank of Sri Lanka in the conduct of its monetary policy as present. So what are the goals of the central bank currently? Is to have what stability? To have price stability, right? To control inflation. So how do you have price stability, guys? How can you have price stability? Is by controlling your inflation, no? Right? That's the main goal, no? The main goal of the entire central bank is to make sure there is price stability. So when there is price stability, they believe that everything else in the economy is also under control. So the primary goal of the Central Bank of Sri Lanka in the conduct of its monetary policy at present is to do this. Remember the, do you all remember the monetary policy framework? Anyone? Monetary policy framework. Currently the focus is on what? From in the monetary policy framework. I'm not going to explain the monetary policy framework. What is the current focus? Of the monetary policy framework. It's what? It's called flexible inflation targeting. Go and check whatever note that you are studying. There should be something that talks about something like that, right? Flexible. Hold on. Okay. So flexible inflation targeting. The framework, guys. Okay. Check your thing. I'm not talking about normal monetary policy. I'm talking about a monetary policy framework. Fast track people. Recording is there. Everything is there. Go and watch if you're forward. Okay. Others, please do check. Somewhere in your note, there should be something called monetary policy framework, right? Under monetary policy framework, you will have two things. One is flexible inflation targeting. What is the other thing? What is the other one? Flexible inflation targeting, is that the other one? Exactly, monetary targeting, right? So you have monetary targeting and flexible inflation targeting. I don't know if it sounds a little Greek to you all. Check in whatever note that you all studied. There should be something like that. Something called monetary policy framework. Under that, there is something called monetary targeting, where you have intermediate operational targets, intermediate targets, and a final target. And you also have flexible inflation targeting. From these two, both are being used, but the main focus is on flexible inflation targeting. So once again, that also proves that the monetary policy at present is looking at stabilizing the inflation, not maintaining the external value of rupee, that is the exchange rate, not to facilitate the government deficit for sure, not really to achieve sustainable economic growth, and to reduce public burden also, not really, right? The main goal of this monetary policy is this, right? To stabilize the inflation at a single digit, to keep it at somewhere around, let's say 4 to 6%. That is what they're ideally trying to do. That's 34. Okay, any questions? Okay, there is one more. Okay, again, a very easy one. What will happen to the money supply? Okay, can you all think and let me know, give me an answer for this. What will happen to money supply and the equilibrium interest rate if the central bank sells securities? Think of what happens to money supply first. Central bank is selling. So that means commercial banks need to buy, right? So As a result, how does this work, guys? Right? Okay, in simple terms, I'll just let you know. I think I would have told this before also, right? So if CBSL sells securities, right? Sells securities, who needs to buy? Remember, we talked about all of this, right? Commercial banks need to buy. So when commercial banks buy, when commercial banks buy, what happens? Their reserves fall, right? The amount of reserves commercial banks have fall. So reserves in com banks fall. So when their reserves fall, the amount of loans that they can give, right? The loans that they can give decrease. And as a result, what happens? Money supply falls. So this story, you all need to know. Okay, so money supply falls. When money supply falls, what happens to interest rate? Supply falling, interest rate. Because interest rate is the price of money always, right? So interest rate increases, right? So that story, it has to work it happens the opposite. If the central bank buys what in the open market, if they buy securities, it's the opposite. If they sell securities, this is what it happens. Yeah, I'm hoping it's a very basic here. So on that end, what answer do we get? The money supply falls, money supply decreases, equilibrium interest rate increases. So we end up with answer number 2 for question 35. Okay. Yeah, that's basically it in the 2017 paper. Can you all just go through, check and see? Let me know how much you all got right. There was 1, 2, 3, 4, 5, 6. There were 6 MCQs. 6 out of 6, no? 5, at least a 4. Nice. If you can get a 6 out of 6 or a 5, I think it's a good thing to be at. Okay. So we'll then get into the 2018 paper. I think 2018 was comparatively very easy. It was very direct questions. Okay. 2018 A-levels. What is the base year of the National Consumer Price Index of Sri Lanka? Base year? NCPI 2012, 2013, right? Directly from theory, there is no explanation to give there. The current base year is this. It's 2012, 2013. No explanation, guys. That's the base year. Okay, and this one, which of the following would generate cost push inflation? Currently also, I think it's 12 and 13. Guys, even right now it's 12 and 13, right? I don't think they had a reverse. Sorry, going back to this question, guys. I'm also a little confused now. They didn't revise this, right? It's still 12 and 13 now? Anyone? Since I had a few questions. If I'm not mistaken, it's still, I'll check and let you all know maybe by next class. It's still 12 and 13 if I'm not mistaken. I don't think there was a revision that was done. Definitely, recently there will not. For example, the years 2019, 2020, 2021 will never be a base year because look of what is happening in the economy. As far as I know, there was no revision, right? So it has to be 12 and 13. Okay, then this one. Which of the following would generate cost push inflation? Now, which of this will generate cost push inflation, guys? The aggregate supply has to fall. Then there will be cost push inflation. So which of this will reduce your aggregate supply? Right? So you have your aggregate demand, right? You have your aggregate supply. So this is your current price. So for you to have cost push inflation, what needs to happen? Your aggregate supply needs to decrease. So which of this will decrease your aggregate supply? 1, 2, 3, 4, 5. Okay, the first one, increase in the price of labor. Looks right? So when the price of labor increases, cost of production increases, aggregate supply shifts. So first one looks right, we'll keep that. Think of the others. A decrease in the price of electricity. So if the price of electricity decrease, cost of production falls. So then the supply curve is shifted to the right? Increase in household consumption, then the aggregate demand curve will shift to the right. There will be demand pull inflation, not cost push inflation. A decrease in government purchase, again, it's aggregate demand that will fall, right? So there is no inflation also. right? And then increase in money supply, it's again your aggregate demand that increases. When money supply increases, investment, consumption, all of that increases, right? So which one will reduce your supply or cost push inflation will be your first one, increase in the price of labor. So cost of production increases. As a result, your prices in the economy also starts to increase. Now your prices are at a higher level. Okay, so this is general price level. I'm hoping you all know the axis. This is general price level. The general price level denotes inflation. So general price level going up means there is inflation in the country. So question number 30, answer number 1. Again, a very direct question. Then going into this, okay, this is a question that I kind of like. Which is most likely to cause an increase in money supply in a certain country? What do you all think? Where will the money supply increase? Okay, we'll go answer by answer. Question, we'll go with option number 5, right? So I think because we discussed that, we just discussed selling securities. So if the government sells securities, right? I'm not going to explain everything now. I just explained like 5 minutes ago. So if the government sells securities, the money supply falls, right? We talked about that. Okay, the answer number 4, if the commercial bank recalls loans, they're not give now. If they give loans, money supply is increasing. Recalling loans is they're doing the opposite of it, right? So if you recall loans, what happens? Again, money supply falls, right? Because you're giving loans, money supply is increasing. You're recalling that you're getting those loans back, means money supply is falling. Okay. So then answer number 3, cash withdrawal by commercial bank depositors. Now, only when people deposit in commercial banks can give in the loan, right? They can keep a portion, they can give out loans and money supply will increase. But if people start withdrawing money, right, again, money supply will fall, right? So if they withdraw money, if consumers withdraw money, what happens? Again, money supply falls. And then number 2, a government budget surplus. What is a budget surplus, guys? Guys, when they take money, money supply doesn't. Okay. First of all, if right, if customers deposit money, what happens to money supply? So remember the whole thing about credit creation, right? A customer comes. Okay, I guess I'm going to answer number 3, right? On the cash withdrawal thing. Now, when a customer comes and deposits, let's say 10,000 rupees, the SRR is there. Then as a result, they will ask by how much does money supply increase in the banking system? So when a customer comes and deposits, money supply will increase. So then the opposite, when a customer withdraws, right, money supply will decrease. The money demand can increase. The money demand means how much people are keeping in the form of cash with them, right? So when they withdraw money, you can say, yes, the money demand is increasing. They're keeping cash with them now, but not the money supply. Okay. Okay, back to question number 2. So a budget surplus, guys, a budget surplus is where the taxes, right? The government revenue is greater than the government expenditure. So they're collecting a lot of taxes and they're not spending much. What do you think happens to money supply now here? The second one. They're collecting money, they're taking money from the people, but they're not spending much. The money supply? Guys, money supply is the total amount of money that is there in the country, right? Government is pulling the money out, right? They're charging taxes, they're taking the money to them, but they're not really spending. The money supply, guys, reduces here, right? This is even if they say a budget surplus, or even if they say a contractionary fiscal policy, so where their taxes are much higher, right? So taxes are higher means they are taking the money out from the economy, they're spending less. Guys, remember withdrawals and injections, right? The withdrawals are higher, taxes are higher, the injection is less. They're putting only a little, they're taking a lot. So money supply is actually falling there. Or you can argue that maybe it doesn't directly affect money supply also, but you can still argue money supply falls also That's also fine. Then the answer, we end up with the first one. But then how is the first one the answer? A balance of payment surplus, right? A balance of payment surplus. Okay, if we take in the current account, it's your exports are greater than your imports. Or if it's a balance of payment surplus, in simple terms, your inflows, right? The money that comes in, money can come in the form of, let's say, exports, let's say primary income, secondary income, right? Let's say foreign direct investment, right? So your inflows that come into the country are greater than your outflows. So there is a lot of money that is coming into the country. Now, for example, your exports, right? So from exports, let's say secondary income, that means people are sending their money into the country, and then that means salaries and stuff, worker remittances. Let's say there is foreign direct investment coming. So as a result of all of this, let's say there is a BOP surplus. What does that mean? There's a lot of money coming into the country. So as a result, money supply increases there, guys. So this is where money supply, hold on, money supply increase. Now, in case they say there is a balance of payment deficit, that means we are paying, right? We are importing a lot. So we are paying a lot of money. So then you can say money supply falls. But given that we have a surplus, that means there's a lot of money coming into the country. Then what we are spending, a lot of money is coming in. The money coming in means the money supply is kind of increasing. So we end up with that answer there. Is that okay? Any arguments on why isn't it something else? Anyone? It's a good question. Why can't it be the second, the third, the fourth, the fifth, the sixth? Any argument? No. Okay, the government budget surplus. Now, guys, what is a budget surplus? Right? So a budget surplus is recall loans means now it's the opposite of giving loans. Now, people who have took loans, they tell them to pay back, right? Yes, a budget surplus, right? That means you have money with you, right? So that is where your income is greater than your expenditure. So as a result, the government has a lot of money with them. So I'll show you, give me a second, right? So income is higher than the expenditure. You'll get that. That's why you have a budget surplus. So let's say, how is the government? Is FDI is foreign direct investment. Okay, so let's say tax revenue. So let's say government is collecting tax revenue of, let's say, 2,000 rupees, and they are spending, right? They are only spending, government is only, sorry, not there, right? Government is only spending, let's say, 1,005. Okay, so they're spending, let's say, 1,005, because I'm explaining point number 2 here, right? They're spending 1,005. So as a result, they have a budget surplus of 500. But look at this, look at the entire thing. They're collecting 2,000, right? Now remember withdrawals and injections in which we study in unit number 5 or unit number 6, unit number 5 and 6 both, right? So this tax revenue here is a withdrawal, right? It's a withdrawal, money is coming. Now, okay, I'll go into recall loans also. Guys, you're missing a fundamental basic point here, guys, on people who are getting confused. So this is the withdrawal, right? They're taking 2,000 out of the economy, right? And they're injecting, right? They're injecting only 1,005. So that is why the money supply is falling there. The charging, people don't get to spend, the government is taking that money from them. You'll get it, no? When you have a budget surplus, yeah, the spending is low, the revenue is high. So as a result, people are, the injections are low. Okay, and then on this point, a cash withdrawal, guys, forget about a cash withdrawal. Think of this one, think of a cash deposit. Okay, guys, budget deficit is, so guys, budget deficit is the opposite of this. Okay, okay, a customer deposits money in the banking system, right? When a person comes and deposits, what happens when there is a cash deposit? banks will keep a certain portion, they will give out more loans, right? So they increase loans. So the loans increase, right? So when the customers come and deposit, let's say a customer came and deposited 1 million, they kept, let's say 20%, the balance 800,000 they gave out as loans. So when they give out as loans, money supply increases. The same way, the other side of it, when a customer withdraws, right? So when there is a cash withdrawal, it's the opposite of it, right? Now when customer comes and withdraws money from the reserves, the bank needs to pay. Bank would have kept some reserves with them. They should pay the customer. So when they are paying the customer, that means now their reserves are falling. So the loans that they can give decrease, right? The loans that they can give decrease. As a result, money supply decreases. That is what happens in the withdrawal part. Okay, that's an explanation for this. Then okay, the recalling loans one. Okay, give me a second, let me write just numbers so in case you're confused. Recalling loans, this is number 3. This is an explanation for 4. Okay, guys, recall loans, not really. Okay, what is the opposite of recalling loans? Trying to explain that. Opposite of recalling loans? Yes, the government provides, if the central bank provides loans, sorry, this is not 4, no, this is 2. Okay, okay. So if they provide loans, what happens? If the commercial bank provide loans, you all know money supply increases. So the same thing, the opposite. You recall the loans. So if you recall the loans, it works the other way around. Money supply decreases. Okay. So always think of the one that you know, then go the opposite page. Not that hard, right? Fine, no? Yes. Now, first of all, you need to understand why do they recall loans, right? The commercial banks don't just recall the loans for the fun of it, no, right? Commercial banks recall loans when they are, let's say, when they don't have enough reserves to meet the SRR kind of, then they recall loans. So you can't argue saying that they recall loans, then the money comes and they give it back as loans again. It doesn't happen that way. Why does the commercial bank recall loans in the first place? It's to cover up their required reserves. So whatever loans they recall goes to the SRR to cover up the SRR. They don't give it out as loans again, right? Because of liquidity issues, exactly, right? So that I'm hoping you all do remember. Okay, so that is the part there. I think it was a good question. Okay, so most likely to increase the money supply, it's number 1. It's a good question which you can learn a lot, right? You need an overall understand of this. Needs a bit of unit number 8. This unit needs a bit of unit number 9 and 10, right? So it's a combination of all the units. A good question. Okay, that's 31. Okay, then 32 is a bit of an easy one. The transaction demand for money is very closely associated with money's function as a what? Transaction demand for money for your day-to-day transactions, money as a medium of exchange, right? So that's a very easy one to think of. Why you keep money for your as a transaction? Well, that's for day-to-day transactions, right? For your as a medium of exchange to do something, to buy something or do something, right? So 32 answer number 4. This is 2018 paper. Okay, the 2000. Okay, the question again a very easy one. Which of the following is a liability of a commercial bank balance sheet? I think a question that we had before as well. What's a liability for a commercial bank? Treasury bills, customer deposits, loans and advances, money at call, bills discounted. Yes, the answer is customer deposits, right? So whatever deposit that has come into their bank, right? Yes, the answer for 32 is 4. Okay. So for 33, it's customer deposits. So whenever a customer comes and right, whenever a customer comes and deposits some money, that is a liability for them. Okay, what is bills discounted? Guys, bills discounted in the sense, now, for example, if you have a treasury bill, right? So let's say you have a treasury bill and you discount that bill. Discount that bill in the sense is you convert, right? So let's say the commercial banks have purchased a treasury bill and kept, let's say it's a 1 year treasury bill, right? So at the 1 year, at the end of 1 year, you can discount it. Discount in the sense you can give that and you can take back cash. So you convert the treasury bill, I'll say TB, into cash. So now they have cash with them. So they have discounted and kept cash with them. So that is again asset for them, right? So even if they say bills purchased, even that's an asset. So they have a treasury bill with them. So treasury bills is also an asset. The bill discounted is also an asset. Guys, money at call in the sense is like they have provided this. Do you know interbank call money market? Right? Have you all studied that? Right? So in the interbank call money market, man, call money market, what has happened here is that this bank has given out a loan, right? They have given a loan in the interbank call money market. So they have money at call. Money at call means whenever they want, let's say it's a commercial bank, let's say they have given it to another bank, right? Let's say they have given some excess money to, let's say, Sampath Bank. So that is called money at call. So whenever they want, they can give these guys a call and tell them to repay. So it's an asset. Okay, happens in the bank call money market, right? So needs to be received. They need to get that money from another bank ideally. Okay, so that's that story for 33. Loans and advances, I'm pretty sure that you all know that is an asset. Loans, treasury bills also, what you have with you is an asset. Okay. There was a question. 10% of part 1 is from unit 7. 10% of part 1 since you mean in forms of questions. Yeah, usually you have around 5 to 6 questions. So it's around 10% of your entire paper. I think every unit is, that's the kind of percentage. Okay. Question 34. What are the key policy tools used by the Central Bank of Sri Lanka in conducting its monetary policy at present? What do you think? 1, 2, 3, 4, 5. Now you all know monetary policy tools. So there is quantitative, qualitative, a lot of things, right? So currently, okay, the one that they mostly use is the fifth one, guys. The policy interest rates and the open market operations, right? Now SRR and stuff like that is not that famous right now. Now in the year 2020, yes, they have changed SRR and done stuff, but in general the most used ones are policy interest rates, that's your bank rate, standing deposit and standing lending, and also open market operation. That is like the most used one, right? Your open market operation, where the central bank buys and sells treasury bonds in order to control money supply. That's the most used one, even rather than policy interest rates. But policy interest rates also, again, standing deposit and standing lending facilities there, right? Remember, you all know this interest rate corridor. If you can control the standing deposit, standing lending, the interest rate corridor gets adjusted. As a result, your money market interest rate, that means your short-term interest rates, can be affected. So usually they use those, right? Rather than SRR and all of that. Yes, they do use SRR, but they're asking you which they mostly use. Because moral suasion is like guidance, it's like advice that the central bank gives, right? So if you talk about now, moral suasion comes under qualitative measures. Check whatever note that you all have. There would be something called qualitative monetary policy instruments, right? So under that, moral suasion is like, now, for example, let's say, right, the central bank wants to reduce the money supply. Okay, so to reduce the money supply, instead of, let's say, what, selling securities or increasing the SRR or stuff like that, what does the central bank do? They go and convey their message. They go and convey their goal to commercial banks. So they say, they pass out the message to commercial banks saying, okay, right now our goal is to kind of reduce the money supply. So please act according to that. So maybe try and give out a lesser loan, right? Try to give out loans a little less. So that is what you call moral suasion. They tell, like they have open communication and they tell them, this is what we want to do. Can you please act according to that? Rather than coming and putting a SRR, increase in the SRR or doing something, they just guide these people, tell them, okay, can you all please do this? This is what we want. Can you all try to achieve that? That is kind of moral suasion. It's a qualitative monetary policy instrument. Okay. Okay, question 33. Give me a second. Okay, this is 33. Okay. Why can't you take 3 as the answer, guys? For this one? Okay, so here they're asking what are the key. Now, guys, all of these are monetary policy tools, right? All of these monetary policy tools. But they're asking from this one, what is the key one? Key in the sense, what is the most used one? So in Sri Lanka, the most used is this, right? This is the most used one, not moral suasion and policy interest rate. And they say key policy tools, that's what Sri Lanka actually uses the most. So they mostly use policy rates and open market operate. That's why it's answer 5 and not 3. Okay. Okay. Okay, that's about money at call and assets. Money at call, you can it's like this. Now it depends on how you interpret it. Now the way I interpreted this, credit squeeze, okay, I've not even heard the term, but credit squeeze in simple terms might be reducing the amount of credit that you're giving out to the public, right? So rather than giving out much credit, maybe you give very less. That could be maybe credit. Guys, so money at call is like this, right? Now, according to the way I interpreted, it's a asset given that they have, let's say, given something which they can reget. Or else you can even call this, you can maybe classify this money at call. You can even say it's not an asset, it's not a liability also. You can simply say it's just simply a facility that you can have, but you can argue it's an asset also. Okay. Okay, that's about the, I think, that paper. There's no other questions. Okay, so I think the next question is from unit number 8. Okay, how much? 34, 33, 32, 4 questions, 5 questions, 6 questions. 6 questions, how many out of 6? All 6 done, sorted. Nice. Okay, so we'll go into, we have 3 more papers. We'll do those 3 and I think I'll wrap things up for today. The 2019, the new syllabus paper, that is what you all would ideally have in all of your past paper books also. I have the 2019 old one also, so we'll discuss that as well. Okay, a easy one now. Okay. Which of the following will lead to a decrease in the economy's money supply? See, there's a lot of questions that they talk about money supply, right? Whatever will increase or decrease or things like that. What do you all think? A decrease in income tax? Decrease in income tax, you can say that people spend more and as a result, money supply can increase, but no direct impact. But again, in what? Answer 1, you can argue that the money supply increases. So if income tax decreases, you can say consumption increases, people spending more, and as a result, money supply increasing, you can say, but again, not a direct impact on money supply. Okay. On the second one, let's say a decrease in the discount rate. Guys, a decrease in the discount rate, how does that affect? How do you think that affects that? Why does money supply increase and the discount rate decreases? Hmm? Okay, you don't have to go in that detail. I'm not going to explain also because that's not really in your syllabus. We don't talk about discounting bonds and all of that. If you all study finance in the future, right? At one point, I don't know if you all are doing a degree, after A levels in finance, probably study about discounting and all of it. Okay, so not really in your syllabus, don't think too much. Yeah, there is a direct answer than that, right? Okay, the third one, an open market operation, open market purchase. So if the central bank purchases, again, it's the opposite, right? Central bank purchases means commercial banks are selling. So who gets the money? Commercial banks gets the money. So as a result, Combank's reserves increase, right? Combank's reserves increase. When the Combank's reserves increase, what happens? The loans increase. They can give out more loans now, and as a result, money supply increases. So again, money supply increases there. Then the fourth one, I think this is very obvious, right? If you increase SRR, right, the ability to provide loans, the ability to give loans decrease. So if the ability to give loans decrease, the money supply will decrease. So CBSL is buying securities. Yes, guys. So in the third one, CBSL is purchasing. So if CBSL is purchasing means CBSL has to pay money, right? Who has the security? Commercial banks have the security. Central bank is buying from them. So central bank buying means central bank is giving the money to the commercial bank. Commercial bank reserves increase. They can provide more loans. Money supply will increase. Okay. That's 4. And then what is 5? Increase in government expenditure. Now the other thing. So you can even call this a budget deficit. Right? Government is spending more. So as a result, again, more spending, MS increases. Okay. If SRR decreases, money supply increases. If SRR decrease, money supply increase. Yes, totally agree. So here the question is asking what will cause a decrease in the money supply. So if you increase the SRR, money supply will decrease. If you decrease the SRR, money supply will increase. Right? Fine. Yes, that's a pretty direct question. Simply how SRR affects the money supply. Yeah. 26, answer number 4. Okay. Nice. Okay. Done with that, we'll go into the next one. Okay. Economy is at full employment. Which of the following will most likely cause demand pull inflation? Because demand pull inflation is where your aggregate demand increases. So which of this will increase your aggregate demand? Right. So you have your aggregate demand, you have your aggregate supply, right? So something that would increase your aggregate demand, that would cause this aggregate demand curve to shift to the right. As a result, there would be demand pull inflation. Which one? Increase in the policy interest rates. Guys, if policy interest rates increase, usually aggregate demand falls, right? Interest rates increase. Increase in income tax. So if personal income tax increase, consumption will fall, aggregate demand will fall. A decrease in the real rate of interest. So if the real rate of interest decrease, that means people will now start borrowing, companies will now start borrowing. As a result, consumption and investment will increase. So if consumption and investment increase, aggregate demand increases, demand pull, inflation. A decrease in government spending, aggregate demand falls, no inflation. A decrease in money supply, again aggregate demand falls. There's no money in the economy. So answer again is answer number 3. Guys, if they give you very simple things, right, which will cause demand pull inflation, which of this will cause cost push inflation, go with the diagram, right? Something that would increase the aggregate demand would cause demand pull inflation. Something that would decrease the aggregate supply would cause cost push inflation. So in your question, see which of this will increase aggregate demand. So if you decrease the real interest rate, right, the third one, what happens here is if the real interest rate falls, okay, so that means the cost of borrowing, right, the cost of borrowing falls. So when the cost of borrowing falls, now what happens, right? Consumption increases. So how does consumption increase? Now, for example, stuff that you all buy for installments and stuff, it's more cheaper, right? The interest you need to pay is less. So people spend more on things like that. Consumption increases. And apart from that, the main thing is your investment. it's the firms that borrow the most. Investment also increases. As a result, what happens? Aggregate demand increases. When aggregate demand increases, there is demand pull inflation. Yes, so increase in policy interest rates, guys. So remember we studied, I think I did not explain that because I explained the other side of it in before. So if the policy interest rates increase, what are the policy interest rates? That is the bank rate. Now usually guys, remember interest rate increasing means money supply will fall, right? Demand pull, demand increases, cost push, supply falls, not supply increases. Okay. Okay, so policy interest rates, you have bank rate, you have standing deposit facility rate, and you have the standing lending facility rate. So if you increase the interest rate, right now, for example, if you are increasing standing deposit and standing lending, that means the money market interest rates are increasing. So as a result, if your interest rate increase, guys, people don't borrow, firms don't borrow, money supply will fall, right? So it's not an increase. Maybe if there's a decrease in policy interest rates, that could have been the answer. Okay. Sip, yes, no. Is it not that hard? So not now, most of it I would have explained in the previous classes also, in previous questions also. That is why I don't go into very detail. Okay, so increase in personal income tax. Guys, remember in unit number 6, what happens? If income tax increase, what happens to your disposable income? YD? Personal taxes increase, YD increases. What happens to YD, guys? If income tax increases? YD falls, right? Your Y, remember your YD, it's your Y minus T, right? So if your taxes are increasing, right? If this is increasing, that means your disposable income is falling. So when your disposable income is falling, what happens to your consumption? Your consumption falls. So consumption falls means aggregate demand falls. So you will not have demand pull inflation. For demand pull inflation, aggregate demand has to increase, right? So that's why, that's the second one. Hoping that's fine. That's that. Yes. Okay. Right, okay, no questions. We'll go. This is not demand pull, it's demand pull. The fifth one. Okay, hold on. If money supply increases, the demand increases. Yes, guys. Yes. So money supply, think of what is money supply. Money supply is the amount of money that is there in the country, right? So if the amount of money circulating in the country is reducing, so that means people don't have money for consumption. There is no money that is there for, not much money that is there for investment purposes. So if the money supply is falling, right? So as a result, what happens? The consumption falls. Consumption, investment, and even government spending, right? All of this falls when money supply falls. Now, practically think, why is the government trying to increase money supply right now? Right now, why is the government trying to increase money supply? Why are they having expansionary monetary policies? They're having expansionary monetary policies to do something and to increase the money supply so that consumption, investment, government spending, all of that will again increase, right? So when money supply falls, all of these components will start to fall. Yes, for the, now is this on this end, right? Trust me, you all can't memorize this unit and you all can't get it, right? On your end, ideally what you need to do is logically try to understand. So go through whatever note that you have, or fast track students, revision class students, right? You all must be having the recording also. Try to logically understand as to, you know, this happens, how will this happen? This is not, they don't put these MCQs in one small area, right? These MCQs are usually tested like in a broader context, right? It's not just unit number 7 knowledge only. They will expect you to have a bit of other knowledge from other units also. Okay. Okay, that's fine. I think everything is fine. Yeah? Okay. So then, okay, this one. 28. Suppose that all banks keep only the minimum reserves required by law, and then there is no currency drain. Legal reserve requirement is 10%. If a customer deposits 1,000 in a current account, what is the maximum amount of increase in total money supply? Because when they say increase in total money supply, do you use the multiplier or do you not use the multiplier? Do we use the multiplier or do we not use the multiplier? We use the multiplier. They're talking about money supply, right? They're not talking about the loan of one government or something. Remember, I explained this. Remember, there is a question that we got wrong, that I gave you a different answer, and then you all told me the textbook is saying a different answer. Remember that explanation? That is what is applicable over here, right? So if the government, not the government, if a customer comes and deposits, remember I told you M1 is equal to currency held by public and demand deposits, in case you were not there last class. So when the customer comes, okay, so how much is our deposit multiplier? Deposit multiplier 1 divided by SRR. How many times? Now example, it's if it's 10%, 1 divided by 0.1, it's 10 times. So that means if a deposit comes, right? So what will be your total deposits? Okay, so your total deposits will be, there will be 1,000 that comes, right? It gets multiplied by 10. As a result, in your entire thing, there will be total deposits of 10,000. Now, if the question asked you, what is the maximum amount of increasing in deposits? Then your answer is 10,000. Remember, I explained this last class. Okay. So if they ask you what is the maximum amount of deposits, answer is 10,000, right? How do you get it? 1,000 comes, deposit multiplier 10. That is what the deposit multiplier is 10. But they're not asking what is the maximum increase in deposits. They're asking what is the maximum increase in money supply. So here you need to ideally figure out that, okay, so demand deposits are increasing by, okay, is the answer 10,000 or is it something else? So demand deposits are increasing by 10,000, right? So money supply is also increasing by 10,000. Is that correct? No, right? Because what is happening? When a customer comes and deposits, you need to figure out this, right? When a customer comes and deposits 1,000, that means from the cash that he has, he's putting in money, right? So the currency held by public, the CC, that is falling. That falls by 1,000. So currency held by public falls by 1,000. It's a minus 1,000. Demand deposits increase by 10,000. As a result, what happens? Money supply only increases by 9,000. So your answer can't be a 10,000. It has to be a 9,000. Which means demand for money falls. There is no demand for money here. Ah, yeah, currency held by public falling. Okay, you can say, yeah, okay, demand for money falling, but don't really connect that there, but okay. Do we need to use a multiplier? That money supply high powered one. Yes, this is a deposit multiplier question, guys. You don't have to use the money multiplier there. That is not needed. It's a customer depositing the waste. Guys, now when they ask you, right, when they ask you a question on a increase in the total money supply, how do you get the total money supply? How do you get total money supply and everything? Total money supply, you can't simply get it by getting a single bank's deposit, right? And when you say total money supply, you're looking at the entire banking system. That's how you went into banking system. Okay. Can we calculate the excess reserves and multiply by 10 to get the answer? You will get the same answer, but then in that case, that is the maximum expansion in loans, right? So that's all. There also, yes, you get 9,000. You can say excess reserve 900 multiplied by 10, but that, yes, you get the same answer, but that's not logically correct. Guys, monopoly bank deposit multiplier is used. I think I explained that. I highlighted on that fact like 100 times last class. Yes, monopoly bank is where you have a single bank in the entire banking system. You do use the deposit multiplier. Okay, check last class's recording in case you missed. Okay, are we fine? Yes, any questions? Well, I think I explained this in detail last class and then we got a different answer and then I changed the entire answer. Yes, can't remember what we did last class, last Saturday, as to exactly how this happens. I just explained in brief terms. I'm hoping, guys, I'm hoping you all do make notes, right? Don't look up and wait and have a good time. Do have a separate book for your past papers, right? In every question, in next to each question, make sure you all have a book. You all do write down whatever that I write, whatever that I teach. Don't just look at the screen and wait. Okay. So I would have explained this last class. If you missed it, go and watch the record. Okay. I think I took it in detail and then we changed the answer. I clearly remember that. So that is that story. Okay. And now remember this, guys. I'll just add in a bit more point, right? Now here they're saying a customer deposits 1,000. That is why currency held by public is falling. Now, in case, right, listen carefully. In case this question said, the banking system had excess reserves of 1,000. Or they said, let's say a single bank, right, a single bank, right, had excess reserves of 1,000. So that means excess reserves of 1,000. As a result, what is the increase in money supply? Then it's simply that excess reserve can be given out as a loan. Then you can say increase in money supply of where there is a 10,000 increase or something like that. I'm just saying. Then you need to realize that the currency held by public is not really affected because people have already put the money inside. So just be a little careful in case we come across a question like that. I'll explain the story. Okay. 28. Remember this. Okay. 29. Okay, a nice one. If the government simultaneously engages in expansionary monetary and fiscal policies, which of the following is the effect on interest rate and unemployment? Okay, first of all, what is the expansionary monetary? What are you doing in expansionary monetary? Okay, we'll talk about the interest rates, expansionary monetary. Yes, in expansionary monetary, what did we do? Interest rates. What do you do to interest rates? You decrease interest rates, right? It can be policy interest rates, it can be whatever interest rate, you decrease it, right? So interest rates decrease. Okay. And then, okay, so from that you're clear that interest rate decreasing. We'll go into this also. We'll talk about a expansionary fiscal. How does that affect interest rate? Okay. So expansionary fiscal, what is happening in expansionary fiscal? The government spending is higher than the taxes, right? They're spending a lot. So when the government is spending a lot, remember now we studied this a little while ago, right? You're having a budget deficit kind of. What do you think happens to money supply? The government is injecting a lot of money in the form of spending, but they're not charging much taxes. What happens to money supply here? Money supply increases, right? We just went through this. When money supply increases, what happens to interest rate? Supply increases. Cost of money, interest rate decreases, right? So interest rate decrease. Now on this end, right, how you get an answer here is, now according to, now they're saying they're having an expansion in monetary and an expansion in fiscal. So now according to expansion in monetary, right, interest rate will decrease. According to expansion in fiscal, money supply increasing. No, hold on. Is it? Wait, I went the wrong way. What is the mistake I made? Give me a second, guys. You have an expansionary monetary, interest rate falls, fine. Expansionary fiscal, government spends more, money supply increases interest rate. No, it can't be an interest rate decrease. Give me a second. No, wait. Can you let me know what the answer is? I'm pretty sure it's not a decrease in interest rate. Because as far as I remember, when you have two expansion, you can't say what the interest happens to the interest rate. The fourth. Okay, yeah, indeterminate, right? Yeah, exact. That is what I'm also looking at. Give me a second. Expansion fiscal, government spending increases. Have I made a small mistake somewhere? I can't figure it out. Government spending is higher than the taxes. The money supply increases. So when this smaller increase expansion monetary and fiscal policies. Hold on. Money supply of money increases. Interest rate decrease. Indeterminate. Okay, we'll leave the interest rate for a while. I'll comment on unemployment. Something is not clicking me. Okay, so what do you think happens to unemployment if you have expansionary fiscal and monetary? What happens to unemployment? Yes, when you have expansionary fiscal and expansionary, why do you have expansionary policy? Is to increase your output, right? Both using expansionary fiscal and expansionary monetary, what is happening? The output is increasing. The output of the economy is increasing. So when the output of the economy is increasing, people are spending more, so businesses are producing. So output increasing means how can firms increase their output? By employing more people, right? So employing more people. So when they employ more people, as a result, what happens? Unemployment for, yeah, that could be so unemployment, you can say it's decreasing. Okay, so on that argument, guys, I would have now according to my explanation also, I feel that it has to go decrease, but I can't remember the exact story. If MS increases, how does the interest rate? Okay, so on this case, okay, yeah, guys, in both the cases, unemployment falls. Right? Now, expansionary fiscal or expansionary monetary, at the end of the day, what are you doing that? You're doing that to increase aggregate demand, right? So when you have expansionary fiscal and expansionary monetary, your aggregate demand increases. So in order to cater that aggregate demand, right, your output will increase. So how does firms increase output? By employing more people. So they're employing more people, and then you can say that the unemployment is falling. So unemployment decreases. Okay, so based on that, we can cut off a few answers. We can say this is gone, right? Unemployment is decreased. This is gone. This is gone. Okay, so now the question arises here. Okay, so you have one answer that says interest rate increases, one answer that says interest rate indeterminate. Guys, indeterminate means you can't really say what happens to the interest rate. Okay, I think we need to, okay, expansion fiscal policy, we cannot create the interest rate. Okay, so it's like this now, expansion fiscal policy. Now you don't have a direct impact on interest rate, right? But on the way that I argued, you can argue and you can say decrease, but there is no answer that says decrease. So given the answers, we can cut off number 2 because definitely not increase, right? Definitely it's not an increase. It has to be a decrease, or you can say indeterminate in the sense we can argue this in the form of, let's say, aggregate demand, unemployment, money supply. I'll get back into this point, right? Government purchase increase, aggregate demand increases, money supply also increases. Aggregate demand increases, interest rate decrease. How? Rise in interest rate due to government borrowings. Okay, you can argue it that way. Okay, that's a good point. Okay, so we'll argue it that way then. Okay, now interest rate, guys. Now expansionary monetary policy, it's a clear point, right? Expansionary monetary policy, interest rate will anyway fall. Okay, that's a normal. That is what expansionary monetary policy means. On expansionary fiscal, I think there was a good answer on this. That was something that some angle that I also did not see. Now, what happens when the government is you can argue that it decreases also based on this. I'll give you another argument, right? Where it increases. Okay, I'll go talk about the crowding out effect a little, right? So when you have an expansionary fiscal, right? What is happening? Your government spending is greater than your taxes. You're spending a lot. So when you're spending a lot, what happens to your borrowing now? Borrowing? You have to borrow? Yes or no? You're earning only 10,000, but you're spending 20,000. So what happens? Government borrowing increases, right? So government borrowing increases. So when government borrowing increases, remember something called a crowding out effect. Once the government starts borrowing from the commercial banks and all of it, remember that? Yes. No, don't remember crowding out effect. When the government comes and borrows from the commercial banks, there is not much of money that is there for the private sector to borrow, right? So what happens when the government comes and borrows? So there will be a crowding out effect. I'm hoping you all know what crowding out effect is. Okay, where when the government comes and borrows, there is not enough of money that is there for the private sector. So as a result, what happens? The interest rate increases. So then you can argue according to this interest rate is decreasing, right? According to this interest rate is decreasing, according to this interest rate is increasing. But again, you can even argue the way that I thought of first also, right? So now on this end, now that is why they have made these answers easy, right? Now on this end, for sure, you know, unemployment is falling. So that way you can cut off these answers. Now, even if you did not think in this angle, right, the angle that I thought before, you still can get the correct answer. Because for definite reasons, you know that the interest rate will not increase. That is for sure. So you can definitely cut off that and go indeterminate. Why is it indeterminate? You can argue based on this. So thank you for that angle. I also did not come into my head. You can argue it on this angle. Is that okay? Yes. So because of this, it increases. Because of this, it decreases. So you don't know which is the increase harder or is the decrease? So is the decrease bigger or is the increase bigger? So as a result, you can't say what exactly happens to interest rate. Got from Google? Nice. That is what I also usually do when I can't figure something out. Okay. So as a result, we go with answer number 4 there. Fine. Okay. Yes or no? Little bit of a tricky question. Expansionary monetary policy output increases. Yes, guys, any expansionary policy, whether it's fiscal, whether it's monetary, why do you have expansionary policy? It's to increase your output, right? To boost the aggregate demand. Remember the entire what cycle, the business cycle. Remember that. If I am to put this entire business cycle thing, right? You have this. So when your economy is down here, right? That is where you have expansionary policies. Why are you having expansion policy? Is actually to increase your output. So how do you have it? It's by increasing your aggregate demand, right? So you have expansionary. Now, for example, if you have expansionary fiscal, your government spending increases, G increases. Expansionary monetary, consumption and investment increase. So consumption, investment, government spending increases means your aggregate demand is increasing. So people are willing to spend more now. So if people are willing to spend more, firms need to increase their output, right? So aggregate output increases. And as a result, what happens? They employ unemployment falls. In both expansionary, money supply also increases. That is debatable. In expansionary monetary, for sure, you can say money supply increases. In the expansionary fiscal, there is an argument there. Okay. Okay, that's 29. I think it was an interesting question. I think something that y'all could learn from. Again, like I said, it is not just looking at one angle. Now, see, this is a money and banking question, right? So I just went into the money and banking side of it, but the examiner's side of it. Now, this comes crowding out effect and all of that we study in unit number 8, public finance, right? How does the government borrow and how does the interest rates affect public finance? They will expect you to know that also to put things here, but you need to be a little bit smart when it comes to your MCQ. Sometimes you can even get the MCQ right without knowing the complete thing. So in my case, if I figure out the unemployment part, I could have figured out the answer, but this is the one for the interest rates also. Okay, that is that. Okay, question 30, a easy one, not that hard. If a 300 million deposit in a commercial bank leads to a 3,000 million increase in money supply, so how much is the multiplier? A 300 is coming as a result, the money supply or the total deposits are increased. Here you don't have to go into that detail, right? Currency held by public, all of that is not needed. Simply think, a 3,000 is coming, money supply is increasing by 300 is coming, money supply is increasing by 3,000 means it's getting multiplied by 10 times, right? 300 to 3,000 is multiplied by 10. That's your multiplier. So how do you get your multiplier? So if your multiplier is 10, how much is your SRR, guys? How do you find multiplier? K is equal to your deposit multiplier is, so I'll say deposit multiplier is 1 divided by SRR. So if your multiplier here is 10, how much is your SRR? So your multiplier is 10. 10 is equal to 1 divided by SRR. So you work things around, you get SRR equals 0.1, right? So 0.1 means how much, guys? It's 10%. Your answer can't be 0.1. It has to be 10%. They're given percentages here. SRR is 10%, or as a, sorry, SRR is 0.1. As a percentage, it is 10%. Okay, so that is how you get the answer. It's a simple question. Don't overthink basic question. Okay, that's question 30. Okay. Okay, that is basically it. Okay, question 30, we have done 1, 2, 3, 4, 5. Okay, 5 questions in the 2019 paper. Are we okay? Yeah. How many out of 5 got everything right? No, I think that interest rate question would have been a little bit confusing. Apart from that, I think everything else was kind of okay, manageable. Okay. Okay, anyone did the 2019 old paper? If you all have done, I'll go through. If not, I'll just skip it. Anyone? 2019, the old syllabus paper, I think it was there in your graph. Okay, there's one person who did. Okay, so we'll go through this faster. Okay, so cost push inflation might start with what? I think a question that we would have gone through. If you all have not done, just still figure it out. Cost push inflation. Anybody, I said what I said, your cost of production has to increase. So when will your cost of production increase? When will you have cost push inflation? Right, so you have your supply this. So the answer could be the first one, right? A rise in money wage, right? So if your wages increase, so if your wages start to increase, there is 2 papers for the 2019. Even for 2020, there are 2 papers. I can't find the old syllabus paper. If not, I would have put that. There is a new and an old paper, not because they wrote 2 papers, guys. It's because the syllabus changed. In 2019 is where the syllabus changed. So until 2018, it was the old syllabus. From 2019 onwards, it was the new syllabus, right? But so now why do they why do they make 2 papers? Because they can't make 1 paper. Why do they make 2 papers? Why now, if 2019 is a new syllabus, why are they making an old syllabus paper in 2019? Why are they making old syllabus paper? 2019 is where the syllabus started, right? Exactly, guys. They make this for the people who are repeating, right? So for, let's say, a person who was repeating A levels, right? That person studied until 2018, so maybe he or she could not get the result that they wanted to, and they're doing it again in 2019. So if they're doing it again in 2019, within that period they can't adapt to a new syllabus, but there is not much change in the syllabus, right? But in general context, that person will still be studying the old things and writing. That is why they make a 2019 paper. Ideally in the 2020 also there should be a old syllabus paper. I couldn't find it because there is third SCI also. So if someone failed in 2018, the person would have tried with the new syllabus in 2019, and again in 2020 also that person could have tried again. You can do A levels thrice, right? So 2020 I don't have the old syllabus paper. I do have the 2019 old syllabus paper. It's very similar to your paper. It's a good paper. That's why I would have included it. If you can find the if you know someone who did third SCI in 2020, I don't know if it's that easy to find someone. If you can find someone who did third SCI in 2020, that means did in 2018, repeated in 2019, again repeated in 2020, that person will have the 2020 old syllabus paper. Again, it will be a good paper. But it will be a little bit of an easy paper because they would not want that person to fail again, right? They would want that person somehow pass off. So it won't be that hard. So that is why you have, even when you have Z scores, right? You had new syllabus Z scores, you had old syllabus Z scores, you have different Z scores because the paper is very different. That thing is there. Okay, so cost push inflation might start as a result of increasing money wage rate. So if the money wage rate increases, cost of production increases as a result, there is cost push inflation. Look at the other answers. Increase in government purchases, it's demand pull inflation. Increase in the quantity of money or money supply, again demand. Increase in money income, right? That means people are earning more money. Again, you can argue your income increases, consumption increases, demand. Reduction in taxes, again, what happens? It's your consumption that increases. So cost push inflation will be 1. Or reduction in taxes, you can even argue that supply increases, right? But what will cause cost push inflation or supply to decrease? It's a rise in money wage rate. Money wage means simply salaries, guys. Okay. Okay, this one. In a hypothetical economy, if the nominal GDP is 8 trillion and the money supply is 2 trillion, the velocity of money. I think it's a very easy question, right? Remember equation of exchange, MV equals PY OPT. Remember, I think I explained this. If they give you nominal GDP, they give you nominal GDP, is it Y or is it PY? Nominal GDP. Y or PY? Exactly, guys, it's PY. If they give you nominal GDP, it's PY both, right? So they're saying money supply increased by 2, right? Increased by 2%. Your nominal GDP increased by 8%. So how much did your velocity of circulation increase by? Increased by 6%. Guys, don't use multiplication here. I'm repeatedly telling you, I think I told you last class also, 2 into 4 is only 8. So it has to be 4. No, because when you have percentages, you add percentages. You don't multiply percentages, right? So it's a 2% increase in money supply and a 6% increase in velocity of circulation. So that is what they're asking, right? That's how you get that answer. This side has to be equal to this side. So velocity of money is 6%. So you end up with answer number 4. Okay. Now, in case this question gave you, right? In case this question told you the real GDP. Okay. If they said real GDP is 8, then that 8 is only this, right? The price, maybe they would have given another additional point highlighting what the price is. But if they have given nominal GDP, remember, it's both of these. Now, for example, in the question, they can confuse you. They can give you nominal GDP and they can give you price level also, right? So if they give you nominal GDP and price level, don't put 8 and add the price also again, because nominal GDP is PY. You don't put another P inside it. If they have given you real GDP, then you can put the price also. Yes, guys, you simply add percentages, right? Because here they are giving you increase, right? Supplies. Oh no, this is not percentages, no. Yes, can someone check me the answer? Are they getting 4? This is not percentage. I also read the question wrong. It's not 2% and 8%. I think it should be 4. Yeah. Can someone check me the answer? It's not. It can't be 8. It's not percentages. I didn't read the question in detail. Anyone has the answer? Someone who read this in? No. Okay, guys, this should not be 8. Sorry, this should not be 6. Okay, these are not percentages, right? I'm sorry. I thought it was percentages. Now, okay, coming back to my point, learn from this. If they said nominal GDP increased by 8%, then you put 8, and money supply increased by 2%, you put 2, and then the answer is 6% here. But here they're not saying 2% and 6%. Here they're directly saying the nominal GDP is 8, money supply is 2 million. This is not percentages, right? So then velocity of circulation has to be 4 times. Okay, sorry about that. So then this is 4 times, and then you get a real GDP of 8 million. Okay, so the nominal GDP of 8 million. That's how you get the answer. Remember, if it's percentages, you add. If they have given numbers like this, you multiply. Okay, read the question carefully. Don't make the mistake I made. So it's not that. Cut off that answer. Okay, so you go with answer number 3. Okay, are we okay? Yes. Did I confuse you all? Say. Thank you for pointing that out. Okay, so we go with answer number 3. Okay, guys, it's always not a multiplying. Be very careful. If they have said it is increased by this percent, then you simply add the percentages. Okay. Right. Okay, going into the next one. I think we might have another question in 2020. Shall we do that question and see? I think there was a 2020 question also. Here also it's not this thing. Yeah, here also it's a number. Okay, fine. Okay, money multiplier is the ratio of what? How do you calculate money multiplier? Guys, if they ask you ratio of something, it's simply what divided by what? Money multiplier is your money supply divided by high powered money, right? So it's a ratio of your money supply to high powered money. Very simple, direct question that is simply asking you what the equation is. You end up with answer number 4. So what is money multiplier? It's the ratio of money supply to high powered money. That's question number 30. Then question 31, again a very easy one. Central bank can increase the money supply by doing which of the following? Selling their gold reserves to commercial banks, selling their foreign currency holdings, buying government bonds in the open market, buying gold and gold from foreign central banks, borrowing reserves from foreign governments. How can you increase, guys? Increase money supply, open market operations. If the central bank goes and purchases bonds, so if the central bank goes and purchases bonds, then what happens? They give the money to commercial banks. So commercial banks are selling, central bank is purchasing. They're giving the money to the commercial bank reserves increase. They can give more loans, money supply increases. A very easy one, because this gold and stuff does not matter here, right? There is no connection really here. So when you have a direct answer, please go with the direct answer. That is 31. Okay, again a very easy one. What does open market refer to? Open market operations is what? Meaning? Simple definition. What is open market operations? Open market operations is buying and selling securities by the central bank. Securities means treasury bills, treasury bonds, all of that. That is what open market. It's not buying shares and stuff. Okay, that's not open market operations. Open market operations is where you buy securities from the central bank, from the commercial banks and stuff like that. Okay, this one. Assume that the SRR is 15%. A commercial bank receives a new deposit of 2,000. Which of the following changes will occur in the bank's balance sheet? 31 answer, I'll come back, guys. What will happen in the bank's balance sheet? So liabilities require reserves. So if you draw the commercial bank's balance sheet, right? a 2000 comes, right? So this is the balance sheet. This side is liabilities, right? So this side is assets. Assets. So there's a 2000 that comes. So when 2000 comes, obviously deposits increase by 2000. So your liabilities, in simple terms, will increase by 2000. And then what happens to your assets side of it? In your assets, you have reserves. Your total reserves, when the 2000 comes, if you're not giving it out as a loan or something, your total reserves will be 2000. How is it broken down? Right. So this total reserves only is broken down, required reserves and excess reserves. Can you all give me numbers for this? How much is required? How much is excess in this? How much is required? How much is excess inside this 2000? SRR is 15%. So inside this 2000 reserves, there is 300 required, 1700 excess. So if the question was how much of loans they can give, it's 1700. How much is the required reserves? It's 300, right? So they have 300 required reserves and they have 1700 which they could have given out as loans as excess reserves. So what is the question asking you? The question is not asking you for total reserves. They're asking you for liabilities. So that will be simply 2000. It will increase by 2000 when the customer comes and deposits. The required reserves will increase by 300. So increase by 2000, increase by 300. You go with answer number 2. Okay, that's 33. Okay, that is done. That's an easy one, not that hard. Okay, I think that's basically it. So we had a few questions. 1, 2, 3, 4, 5, 6. So generally you do have around 5 to 6 questions from money and bank. Okay, the last paper, 13 minutes to go. If you finish off by now. Okay, now think this was your actual paper. You have done all those papers. You've done from 2011 to 2019. Like you've done all around 10 papers. And now you're actually sitting for A-levels in 2020. Now figure out, let's see how much can you actually get correct. Okay, now you'll realize it's the same questions that they would have asked in different ways. Okay, look at this. Suppose that in a hypothetical economy, real GDP equals 80 trillion, nominal GDP equals 240 trillion, general price level is 3. If the money supply is 30 trillion, velocity of circulation, same thing that was there in the last paper, no? 2019 paper, if you've done and gone. Now, MV equals PY. Same thing, they have not even converted that into percentage. Money supply, they have given as 30 trillion. Okay, so it's a 30 trillion. Velocity of circulation, you don't know, you're finding that. Now, what do I put here? How much is the number I should put here? Can someone tell me? For PY, how much do I put? Okay, remember guys, you can either put this, right? So you can either say price is 3, real GDP is 80, so 3 into 80. You can say it that way. Or else you can put the nominal GDP. So both the things you still get 240. Okay, so it can be price, sorry, it can be price 3 into 80, the real GDP, or directly the nominal GDP. So be very careful. Don't ever put 240 nominal GDP into 3. That is where the entire thing goes wrong. Okay, so we'll put the entire 240 here, right? So then move things around, you get B. How much is B, guys? That will be 240 divided by 30, you get 8. So that is the velocity of circulation. It's 8 times. That will be our answer. 2020, question 26. Not a hard one, a very easy one. Remember, in case they have given you percentages, then you need to add. Increased by this percent, increased by, decreased by this percent, then you add. But if they have given you numbers like this, you can simply multiply. Okay, that's question 26. Okay, question 27. Okay, I kind of like this question. It's a good one. Assume that one of the commercial banks in the banking system has excess reserves of 400 million. So they have excess reserves 400. So currently they have excess reserves 400 million. Okay. And then what is happening here is they're saying the SRR is 20%, but excess reserve 400. Fine. Meanwhile, a customer of this bank deposits 25 million in the current account. Okay. So when a customer comes and deposits 25 million, how much gets added to excess reserves from that 25? When a customer comes and deposits 25 million, right? So he deposits 25 million. From this 25 million, can you all tell me how much is the required reserve? How much is the excess reserve? Right? How much they have to keep with them? They have to keep with them 20%, right? So required reserve is how much? 5 million, right? So RR is 5 million and the excess reserves is 20 million. Okay. So now can you tell me at this position, how much of excess reserve does the bank have after this customer came and put? They already had 400. Now when a customer came and put another 25, now they have 420 million excess reserve. Do you understand that? They had excess reserve of 400. One customer came and put another 25. From that 5 million, they had to keep SRR. Now they have 420 excess reserve. So now from this 420, the bank is lending 120 to another customer. So what you have as excess reserve, you can give out as loans. So they have 420. From this, they're giving out 120 million to one customer who is coming and asking. So now the question here is, how much additional lending can be granted by this bank? How much additional lending? What do you all think? They had 420, they gave away 120. How much more can they give? How much more loans can they give? Whatever that they have in excess, they can give out as loans, right? So your excess reserve, whatever you have, you can give out as loans. So you have 300 million excess. That is your answer. Okay, so you end up with answer number 5. Is this a monopoly bank? That doesn't matter, guys. It doesn't matter whether it's a monopoly bank or not a monopoly bank. I don't think they have told that. No, that one of the commercial banks in the bank, it's not a monopoly bank also. So guys, this is a single bank question, right? Why can't 305 be the answer? How do you get 305? Okay, so 305 you would have got by adding this entire 25. You would have added entire 25 here. You can't add the entire 25 because you had 400. Customer came and put 25. So when a customer puts a 25 deposit, you can't give the entire 25 deposit as loans. Only the excess part you can give out as loans. So what is the excess part from this 25? The 5 million is required. The 20 million is excess. So that's why I only put 20 here. You can't put the entire 25. So then they had a total of 420. From that 420 excess reserve, they gave out 120. So how much more can they give out? Another 300 they can give out. Okay, that's that. That's question 27. Then we go into question 28. Okay, again, a very easy one. I don't think you get questions easy as this. The main objectives of central bank in implementing the monetary policy. Why do they implement the monetary policy? In order to achieve what and what? Okay. Simple thing. Objectives of the central bank. In order to achieve the objectives of the central bank only, they implement the monetary policy. What are the objectives of the central bank? It's price stability and financial system stability. Right? So they implement the monetary policy in order to achieve their objectives. So what are their objectives? This and this. Okay. Done. Question 29. Okay, go through this and see. Suppose the SRR is 10%, central bank conducts an open market purchase of 300 million. What is the maximum possible change in money supply? Because when they say money supply, remember, you need to use the multiplier here. Okay, what do you think happens? Okay, so first of all, when the central bank purchases this thing, can you tell me first if money supply increases or decreases? That's the first thing that you need to think. Is it an increase or a decrease? Central bank is purchasing stuff. So money supply increases. That's the first thing you figure out. Then by how much does it increase? So when central bank purchases, okay, what happens? That 300 million from the central bank, it goes to the commercial bank. Now, the commercial bank has excess reserves of 300. Their reserves have increased. So now when they give out this reserve, right? So that this 300, they give it to one person, right? So that person puts in another bank. It goes on like that, right? So how much is our deposit multiplier? Our deposit multiplier, if the SRR is 10, by now I'm not going to show you how to calculate. It's 10 times. And as a result, your deposits increase by 3000 million. So you have excess reserves 10, it gets multiplied by 10 times. And as a result, deposits increase by 3000. Is that okay? A simple question, guys. Central bank purchasing, money comes into the commercial bank. So commercial banks have 300 now. So if they give that out as loans, see here, there is no currency held by public, right? Currency held by public is not decreasing. It's not a customer coming and putting money. No, customer is not depositing. So simply money supply will increase by 300. So there is an excess reserve. Remember I told you, if there are excess reserves in the banking system, I'm hoping you all were following a previous question I told you, right? The same question where the customer deposits I told you. If the question said there is an excess reserve, then how does it work? It's simply that multiplied by the deposit multiplier. So here this creates an excess reserve, right? When the central bank purchases, the money comes into the commercial banks. Now commercial banks have 300 excess. So if they give out as loans, at the end, deposits will increase by 3000 million. So money supply also increases by 3000 million. Okay. So the answer then is an increase of 3000 million. Question 29, answer number 3. When the customer deposits, money supply and total deposit different. Yes. So when a customer deposits, the currency held by public will fall. No. So money supply and deposits will not be the same. Now in this case, right, if you look at money supply, it's currency held by public and demand deposits. So if you look at this case, right, demand deposits are actually currency held by public. There is no change, guys. They're not saying the customer is withdrawing or taking money. So currency held by public, no change. Demand deposits is increasing by how much? 3000 million. So as a result, money supply also increases. So in this question, if they ask you by how much is demand deposits increasing or how much is money supply increasing, it's the same thing. But in our previous cases, remember, if a customer came and deposited that 300, then there will be currency held by public minus 300. Money supply will only increase by 27. But here customer is not coming and doing anything. No, it's just an excess reserve being created as a result of central bank purchase. That is why it goes like this. Pick up those small points, guys, right? It will not be taught in theory. That is the points that you all pick up while doing questions. Are we okay? Sep, no? Too tired now? Okay, we have 2 minutes to go. Okay, easy one. Question 30. Monetary policy affects the aggregate demand through changes in what? Easy one. I have been saying this over and over again. Monetary policy affects aggregate demand through changes in monetary policy, not fiscal policy. Monetary policy. If you change interest rate, what changes? It's your consumption and investment that changes, right? So if you increase the interest rate, consumption and investment will fall. If you decrease the interest rate, consumption and investment will increase. Easy one. That's 30. Not share prices, not taxes, not export demand, not any of the others. Okay. Okay, that's it. No other questions. Okay, nice. 1, 2, 3, 4, 5. Okay, there were 5 questions. So I'm guessing in your paper also there will be 5. So if you've got 5 out of 5 or at least around a 4, that means you're completely, I think you're most of it, you're okay. So if you can get 4 out of 5, that means from 50 questions, you can get 40 questions right now. Right? So at least 4 out of 5 or at least 5 out of 5. 5 out of 5, then that's a good place. We are at least 4 means you can get things done. So that is the end of the MCQs. I'm not going to start the essay questions. I'm also a little bit running out of time, which I need to start studying for my exam on Tuesday. Not an easy one. I think it's even more harder than your A levels, but I am not taking it seriously for some reason. I need to take it seriously at least starting today. So I'll get that done. And on your end, what we will be doing is we'll start the essay questions next Saturday morning, same time. I'm not going to take Saturday night slot. So okay, so I'll take the Saturday morning slot the same time. We'll start with the essay questions. So please do it and come. We're starting with 2011, right? Question number 6 in your essay questions. Okay, that's it. If I have small questions, I can stay and clarify. If not, thank you for coming. I'll see you all next class Saturday morning. See you guys. Have a good day. See you. Bye.